All right, today is still Thursday, the 27th. This is still Accounting 1. We're in Chapter 2. We're at page 64, 65, just talking about journal entries. In Chapter 1, we walked through Net Solutions and Cecil Jameson, attorney at law, and I added the journal entries as we did each transaction. If you recall, I said this transaction sounds like this: debit this, credit that. So this should be like, oh, okay, that's what he was doing, because we were doing journal entries then. So the second transaction for Net Solutions is an example on page 65 that he paid, bottom of the page, paid $20,000 for the purchase of land. And so land is an asset, and an asset has a normal debit balance. So when you increase an asset, you're going to debit that. So we're going to debit land for $20,000. And then what did he use to pay for that land? Well, it wasn't a note payable, it was actually cash. So he took one asset and paid for another. So we're going to increase land and we're going to decrease cash by crediting cash. So that's how that second transaction looks in a journal entry format. Debit land, credit cash, $20,000, and that was to purchase land for use as a future building site. Next one. So we're going to go through these 10 or 11 transactions for Net Solutions and just show you the journal entry. So the next one says, Transaction C, this is on page 66, purchased supplies on account. And in my book, I circled the words on account, that because when I first see the word purchase, it makes me want to say, hey, I wrote a check. Well, I didn't write a check. I'm going to write a check later after I get a bill from my supplier. So we purchased these assets on account, which means we didn't pay for them yet, but we did get the supplies. So in this case, we're going to debit an asset called supplies, and in your head, think supplies inventory. And remember, when you're done with accounting class, don't put this in an asset again, just debit expense. And we'll credit an account called accounts payable, which is a liability account, which means we owe, OWE, somebody this money, which is our supplier. They're going to give us an invoice. So debit supplies inventory, credit accounts payable for $1,350. And the only difference between this and accounting in Chapter 1 is that I just spoke the journal entry to you. Now you can actually see it and how it would look like on paper. On transaction letter D, we received cash. And let's stop right there. We don't care what we received it for yet, but we received cash. And one of the things I've noticed over the years with some Accounting 1 students is they get frustrated with not being able to see the transaction in their head all at once. That we debit this and credit that. Well, first of all, I'm a lot older than all of you, and I've got a lot more practice, so I'm pretty good at this. Secondly, I've been through the book 70 times, so I've got an idea of what's coming. Build these transactions as slowly as you need to. You know there's going to be at least one debit and one credit and a dollar amount involved. So if you pick something that you are comfortable with and say, I know that whenever I receive cash, when it says received cash, I know that it's a debit to cash. Hands down, debit to cash. Well, so let's do that. We received cash. Stop. We're going to debit cash for whatever that dollar amount is. So that dollar amount was $7,500. So debit cash, $7,500. Well, we also know that debits have to equal credits. So on the credit column, put $7,500. And now let's guess or figure out, what are we going to credit? We've got 3 of the 4 things already in there. We've got a debit to cash account for $7,500, and we put the $7,500 dollar amount in the credit column. All we have to figure out is, what account are we going to credit? So we've got 3/4 of the entry written simply because we know we have to debit cash. Okay, I'm just trying to give you some process to help you not write these backwards or get frustrated if you can't see the whole entry in your head all at once. Just build it slowly, and with practice, it comes. So let's read the rest of the transaction. Received cash of $7,500 from customers for services provided. It didn't say from customers for payment on account. It says from customers for services provided, which sounds like it was a cash deal. I did the work, they paid me right there. So what can we credit? If we go back to our 5 things, asset, liability, equity, revenue, expense, debit, credit, 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 debit, let's look at those credits. One of them is a liability. Did we owe anybody any money? Are we going to owe somebody any money at the end of this? Well, no. Did we put any more money in? That would be the equity one. Well, no, we didn't do that. Did we sell something? Is it a revenue? Yeah, we sold something. So let's credit a revenue account. In this case, we call it fees earned. It's just a process of elimination. We have very few choices. So, try to, just stay calm and do it one line at a time. And what happens if you do it wrong? Oh, well, we'll fix it tomorrow. I think I'm smart enough to be a brain surgeon, but I don't want to be a brain surgeon because, I've got to do it right there. And I just don't have the emotional makeup for that. If I mess something up at 10 to 5 in my accounting work, and I want to go home at 5 o'clock, I go home at 5 o'clock, and I write a little note, a sticky note on my desk and say, fix this tomorrow. Now, you can't do that as a brain surgeon. I'll be back tomorrow and fix this. So that's what I like about accounting, is that I can fix it tomorrow. Next one. Letter E, Net Solutions incurred the following expenses. Incurred the following expenses. We got wages, rent, utilities, miscellaneous. This entry looks kind of like, for those of you who have had accounting in high school, this looks like the posting from a cash disbursements journal. In today's modern world, we're going to write a check for each one of these transactions. So we're going to have a separate entry for each one. So you're not going to see this kind of entry very often. But this is just to help get a number of expenses recorded without having 5 journal entries. We only have 1. So we're going to debit the expenses because that's the last one of the 5, right? Asset, liability, equity, revenue, and expense. Debit, credit, 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 debit. So we're going to debit the expenses and credit cash because we wrote a check. Well, checks. And we made cash smaller. So when you see the word incurred the following expenses, I wish they would have said paid the following expenses. If they say paid, then we know right away we're crediting cash. So let's do that. Let's add them up. If we add those up, they add up to the number they've got here, 3650. Let's put the credit in there right away. Credit cash for 3650, and then we'll just add the debits in. So debit wages, rent, utilities, and miscellaneous expenses for the proper amounts. We're done. Like I said, you're probably not going to see a journal entry that looks like that unless you're doing a hand-operated accounting system. This is like a posting from a cash disbursements journal at the end of a month. And QuickBooks and Sage 50 they don't use journals. So every time you write a check, it does the entry for you. So it doesn't care how many journal entries it writes. Next. This one I like. It says Net Solutions paid, stop. You see the word paid and you think immediately credit cash because cash went down. So now we've got 1/4 of the entry written. Let's keep going. On account 950. Well, on account, maybe we don't know what on account means, but we know 950. So let's credit cash for $950, and we'll debit something for $950. So we've got 3 of the 4 components of the entry done. Now let's figure out what on account means. So we're going to debit something. Now, did we increase an asset? Did we buy something with that cash? No. Did we pay somebody back that we owe them? That's the answer. We paid back something that we owe to other people, so we're going to reduce a liability account. So we're going to debit accounts payable. So debit accounts payable, credit cash, $950. The next one, Chris Clark determined that the cost of supplies on hand at November 30 was $550. We did the math for this, but we did the math for this in chapter 1. This is getting us to learn a very common calculation in accounting. Beginning balance plus purchases less ending balance is cost of goods sold. So they're trying to teach us this cost of goods sold calculation using the supplies inventory amount. And that's okay. We'll get better at it as we go. But remember, we calculated this as an $800 reduction of our asset last week. This is what's known as an adjusting journal entry, and that's really chapter 3. So we're adjusting accounts to what we calculated them to be. So in this case, we're going to reduce our supplies inventory by $800 to make it match up with what we think it should be, the $550. And the offset will be to supplies expense, because what we're saying is we used up $800 worth of supplies. So we can't leave it in our asset account if we used it. We have to move it over into expense. Now, since there's another principle here that they don't talk about in the book very much called the materiality principle, materiality, which really means, is it really big enough to worry about? If it's a dinky thing, then don't fuss with it. And so that's fuss, F-U-S-S, don't fuss with it. So anyway, I want to be clear. I didn't want anybody to be calling the dean saying, well, you should have heard what, okay, sorry. I'll pick a different word and make sure that I'm not being misconstrued by anybody. I heard it right away. I go, oh, I better clarify. So anyway, if it's a small amount, don't concern yourself with it because it's a small amount. That's what materiality means. So let's say we got our supplies cabinet, and our supplies cabinet has pencils and pens and Post-it notes and paper clips and rubber bands and whatnot in it. And every time somebody goes to get a bottle of whiteout, we're not going to make them write down that they've got a bottle of whiteout. And then at the end of the day, we're going to write a journal entry that says, debit supplies expense for $1.50 and credit supplies inventory for $1.50 because somebody took a bottle of whiteout out of there. Well, no, that's just too much time to spend on something like office supplies. You would do this once a month or once a quarter or something like that and say, well, for the month of November, we used about 800, and this again is an approximation. Thank goodness they made this a round number, that we used about $800 worth of stuff. It's, for you as the accountant anywhere, don't spend a day listing out everything in the supplies cabinet in detail and then writing a journal entry that says, debit supplies expense, $817.14. That's way too much time to spend on that. Just, you should spend that time balancing cash, not worrying about Post-it notes and paper clips. So that's what this is just a journal entry to adjust our supplies inventory to its approximate balance. And the approximate balance is what Chris Clark thinks is about $550. So to get from $1,350, the original balance, to $550, we have to reduce our supplies by $800. So that's what that is. Debit supplies expense, credit supplies inventory, $800. I'm going to pound on that every chance I get. Now, remember what I said already today once. When you buy supplies inventory outside of a classroom, don't bother putting it in supplies inventory. Just debit expense right away. So let's say when Chris Clark bought that supplies on account, I would have debited supplies expense, credited accounts payable. Now you might say, well, you didn't use it all. You're understating assets. Well, it's only $550. It doesn't matter. You're spending too much time with it. Another example, I used to do some accounting work for a nonprofit theater that had some concession candy. And so they had maybe $200-300 worth of candy. And somebody asked me what the inventory of candy was. I said, I don't know. And they said, you don't count the inventory? No, whenever we buy candy, I expense it. It's cost of goods sold immediately. They said, well, shouldn't you keep inventory? I said, go out to the concession stand and look in the cabinet and tell me how many thousands of dollars we have in there in uneaten candy bars. And they go in there and say, well, maybe it's 50 bucks. Exactly, maybe it's 50 bucks. So that's why I expense it right away. It makes no sense to concern myself with it. Now, non-accountants don't get that. They think we're being lazy. No, we're focusing on stuff that's more important, like the cash balance. Next, the last one is where Chris Clark took money out and he withdrew $2,000. Well, that sounds like he took cash out, so let's credit cash for $2,000 and let's figure out what we're going to debit. And this one we're not, you know, as we have a few debits to this account every year, but we're not going to have, you know, 14 of these every month. But whenever the owner takes money out, you should debit one of two things: either debit the capital account directly, or open up a drawing account like we have here and debit that. So debit Chris Clark drawing, credit cash, 2,000 bucks. That's it. So now we've journalized all those transactions. There are typically, depending on the textbook, about 8 steps in the accounting cycle. About 8 steps. The first one is always journalizing. We're analyzing and journalizing the transactions. Well, we just did that. The second step is post, journalize post. Now, this is kind of what we do through most of each month. Journalize post, journalize post, journalize post, journalize post. And then the rest of the accounting cycle happens after the end of the month. So after November 30th, we'll do the rest of the stuff. We will prepare a trial balance and then adjusting entries and an adjusted trial balance and financial statements, closing entries, closing trial balance, done. But that doesn't happen in November for Chris Clark. That happens in the first week of December. So the most of what the bookkeeping of this is the first two, journalize, post. What we journalize, to journalize is we've got the whole transaction in one spot. So let's go back to our accounts payable entry at the top of page 67, where we paid for some of our accounts payable. We debited accounts payable, credited cash for $950. The whole transaction is right there in the general journal. We journalized in the journal. Okay, now that's important. We journalized in the journal. The whole transaction is right there. Then we break that up into its pieces and we post to the ledger. So when people talk about the books, there's always at least two. There's a journal and a ledger. You journalize in the journal, you post in the ledger. So let's take a look at that. They're going to use, I'm not sure why they're using December now, but okay. On page 66, I think, is it? 68, journalizing and posting to accounts. We have to take these transactions that we journalized as a unit and then put them in their account home. Like that table on page 60, which looks like the table on page 19, that this is really looks like posting. I said this looks like the general ledger and the trial balance. If you take a look at our cash column, that's all the transactions that happened in cash. That's what posting is, taking each journal entry and putting those amounts in their account home where it belongs. So if we take a look at this, now we're moving into December. I wish we had posted November, but we're moving into December. On page 68, Net Solutions paid a premium of $2,400 for an insurance policy for liability, theft, and fire. The policy covers a 1-year period. Okay, so they're adding a couple of things here. They're adding another asset account that we have to learn about, and we're going to post this to a general ledger. So two things are happening with this particular journal entry. Notice we haven't talked about this particular asset before. This is called prepaid. We pay in advance, prepaid insurance. This is like rent. Doesn't your landlord want you to pay the rent on the first day of the month? Yeah, nobody wants to get paid. No landlord wants you to live there for the month and then get paid. You know, you need to pay up front. Insurance is the same way. You can't buy the fire insurance the day after the fire. You know, they want you to buy the insurance before the fire. Then it wouldn't be insurance. But anyway, so Chris Clark bought a year's worth of insurance in advance. Well, for $2,400. The reason that's not going to insurance expense, and again, this is December 1st, is that insurance is covering a whole year, not just December. If we debited an account called insurance expense for $2,400 and dated that December 1st, that would make December net income look pretty low because we attached a full year's worth of insurance to December. What you should do then is spread that out over the year. And this is an excellent opportunity to use an Excel spreadsheet. So before Excel, we would have one of those 13 or 14 column worksheets that was our prepaid expense worksheet, and just spread it out for the full year and then write the journal entries from that. Well, now when Excel came around, it's like, perfect. This is exactly what we need for prepaid expenses, which is a great example is insurance. So we debit prepaid, credit cash for $2,400. Now this prepaid expense or prepaid insurance asset is an asset account. We own, OWN, we own this insurance. And what happens if we cancel? If we cancel this policy, we get a refund back. So we're not covered by insurance anymore, but we get a refund back. So that's why it's called an asset. Now next on page, so we learned about prepaids now, but next, what about posting this journal entry? We have to take each of its components and put it in its account home. We journalize in the journal, we post in the ledger. So imagine, and I want you to imagine these as books, all right? I mean, physical books, 3-ring binders, if you will. That the general journal is a separate 3-ring binder. And we've got, and the pages are numbered and dated. And we do it in reverse order. So the most recent one is on top, and then when you turn it to the right, you put another one on top. So as you go deeper into the general journal, you go back in time. Now the general ledger is going to be a separate book, and each page will be for a particular account. It will be in accounting order. Assets first, liabilities, equity, revenue, expense. The first page of almost every general ledger is going to be cash. Accounts receivable, prepaid insurance, fixed assets like land, building, equipment, other investments, that kind of stuff. And then accounts payable, notes payable, wages payable, Chris Clark capital, Chris Clark drawing, fees earned, wage expense, rent expense, utility expense, miscellaneous expense. It's going to be, and each one is going to have a page. And when you fill up a page, because you'll fill up cash pretty quick, just add a new one on top of the cash bunch. So think of these like that, as opposed to these small pieces. So we've got our general journal open in front of us, and we need to post this journal entry to our general ledger. So we'll put the journal entry, if you're right-handed, you'll probably put the general ledger on your left and your general journal on the left, general ledger on the right, because you're going to be posting to the ledger. And you'll see that, okay, I need to post a debit to prepaid insurance. So you're going to turn to the prepaid insurance page in your general ledger, and you're going to do what you see right there on page 69. Put the date in for December 1st. Got a little tickle here. And notice there's a posting reference. Now, don't focus on this, but I'll tell you why the posting references were there, so you can see where this came from. If you're using QuickBooks or Peachtree, this stuff doesn't exist. But if you're doing this by hand with green or buff colored paper, then yeah, put the posting reference in. That 2 says that came from my general journal, page 2. We'll look up at the journal at the top of the page and look over to the upper right, and you see page 2 right there. So if I want to know where this entry came from, and I'm just looking at the ledger, this is telling me that it came from my general journal, page 2. And I put the $2,400 in, and I have a remaining debit balance of $2,400. So then I would go to my general journal, and I would write the 15 in there. And that 15 says that on the 15th page of my general ledger, this is where this is posted. Now, I wouldn't put that in there until I'm done posting that entry. So what happens if the phone rings, I have to go to the bathroom, or the building catches on fire? I can come back and I say, oh, that 15 is there. That means I posted that. So now I can go to the next line down and do the cash side. So then I'll flip back to the front page of the general ledger, and I'll go to the bottom of where I've posted, and I'll put in December 1st, and I'll put in my $2,400 credit and my running balance. Notice that 5,900 minus 24 is 3,500. I'll put in my posting reference of 2. That tells me that I'm done posting that side. Then I'll go back to my general journal, and I'll put my posting reference there of 11, saying I'm done with that journal entry. So then if I go home and I come back the next day, I'll see that, well, I posted that whole entry there. I've got posting references. Where's the next entry that I need to post? So those posting references are there for 2 reasons. So I can go back and forth and see where the supporting detail is, and it keeps track of where I am in my day in case I get called away. My supervisor needs to see me, I get sick, I have to go to the bathroom, it's coffee time or lunch break or whatever. I use that as my bookmarks. Now, QuickBooks, Sage 50, it journalizes and posts for you. So you don't do this. You key in the transaction, and it does. And as soon as, like for QuickBooks, when we do QuickBooks is, I think, first in the springtime, and we turn all the sound off. But if the sound was still on for where you work, and you hit save and new or save and close because we wrote a check to pay for, I don't know, insurance. No, let's use utilities. We wrote a check to pay for utilities, so we're going to debit utility expense and credit cash. But when we do that in QuickBooks, we actually key that in to write the check, that we're going to pay a line of energy, so much money for this particular invoice and whatever. And then we're going to hit save and new because we've got another bill to pay for. And when we hit save and new, QuickBooks will chirp at us. It'll go boop, boop. And when it does the boop, boop, that is posting both sides of that. It's posting the debit and the credit because we told them where to post that. So when we write checks in QuickBooks or Sage 50 and we hit enter, it does this stuff behind the scenes. That's why we still believe as instructors we need to teach how this is done by hand so you know what's happening in QuickBooks and Sage 50 and almost any other accounting software. So this is posting, taking the journal and posting it to its proper home. Okay, it's 9:45. Let's take another 10 minutes. And we'll come back and kind of wrap up a few things. So let's come back at 5 till. All righty, we good with that? Okay.